When you're age 30, you tend to have partners, try to get married, potentially later on have kids. These are all big transitions in life. So it is the biggest financial decision period for that sort of time frame. And when you're doing upgrading and taking larger loans, growing families, and also this is probably where people making the most of the working income. So this window will give you the most powerful and advantage in planning time for you to grow, compound sort of investment and interest, and also being able to have a investment portfolio, design what you can do for your retirement or planning, and having a passive income structure set up during this period so that after age 55 you'd be more relaxed without any burden.
Welcome to the Inspired to Thrive podcast. I'm your host, Phoebe Lay, and in each episode, I will be sharing with you insights from either an inspiring person or myself to help you thrive and shine online and in person. We talk about all things marketing, relationships, money, business, growth, mindset, and more. So thanks for tuning in, and I look forward to seeing you inspired to thrive. What if early retirement wasn't about stopping work, but about creating choice, flexibility, and peace of mind earlier in life? Hey, I'm Phoebe Lay, and welcome to the Inspired to Thrive and Shine podcast. Today's guest is Jenny Huang, an experienced lending specialist and finance professional with over a decade in the Australian mortgage and financial services industry. Jenny began her career at Westpac before founding Grab Home Loans, a mortgage brokerage built on transparency, education, and long-term client relationships, now backed by more than 228 five-star Google reviews. Her work has since expanded beyond lending alone. Jenny is a co-founder of Allen's Property Services, Finance First Group, and HT Legal & Co. Group, bringing together finance, property, and legal expertise to support clients through every stage of their financial journey. In this session of our 4-part series, we are exploring what early retirement really means, why the ages of 30 to 55 are such critical windows for planning, and how structured timing and informed decisions today can create far greater freedom for tomorrow. So whether you're early in your career or thinking more seriously about your financial future, this conversation will help you start seeing early retirement through a cleaner and more grounded lens. So let's dive in. Jenny, welcome to the show.
Hello, Phoebe. Thanks for the invitation.
It's so good to have you on. I wanted to hear your thoughts right from the get-go of what people think about when they hear the phrase early retirement and how they usually react or what their assumptions are when that phrase early retirement is dropped.
I think when it comes to the phase of early retirement, what most people are assuming is they can retire, that they stop working at age 50s or early 50s in the mid or late 40s. That's what they call it, early retirement, with a large sum of cash and property to support their day-to-day life after retirement, after they stop working. But they actually don't really realize what the realistic of, if you actually stop working or if you actually doesn't really have an income, there will be a risk of inflation. And these days, the cost of living is very high as well.
These are some really good points that you make. And obviously, from your perspective, early retirement is something that's really doable, and it's something that a lot of people strive for, but they don't necessarily believe internally that it is possible. So I want to hear, what is it about? Like, is it about your income, your assets, or something else?
The actual early retirement in my mind is actually a mindset that you will be able to not just stop working, but you'll be able to be more flexible of choosing the work you like, having passive income ready for yourself, having some investment ready for yourself so that you can be flexible with choosing, to work a bit less, you even working your own hours, having the financial freedom and being able to make your own choice in life instead of actually fully stopping, call it retirement. What we wanted to help people, the purpose of me being here is help people understanding what they can do to actually plan for their early retirement.
Jenny, I want to know, why do you think this is something that's relevant for people right now, especially even like their 20s and their 30s? People are thinking about the now, they want to live for the now, have fun, YOLO. Why should people be thinking about retiring early or seeing that as something that's relevant for right now?
See, I wish I have someone telling me when I was in my 20s and I should be planning things earlier. It's about education, right? So people usually think, okay, I have to work. Traditional idea is you have to work flat out until you're age 65, that the retirement age, and you don't really think about the rise cost of living. Everyone is thinking about their income and their work. So at the same time, there is constant changes around the interest rates, living cost, superannuation tax. And also these days, with all the high cost of living, the burnout of work happens really early as well because everyone tends to work more, having to do more overtime to try to support a family. Family responsibility is also heavier with multiple kids, with even child education is quite extensive as well. So planning or thinking about early retiring or planning for your income and investment, it's just giving yourself a more flexibility to reducing your work hours, having a little break when you want to, and spend a bit more time with family, not feeling like you're trapped in financial burden. So it's not about stop working. It's about building your own resilience and taking control of your own life. I'm here to help you to try to understand a bit more about superannuation, investment, property strategies, how we can make it more effective tax plan as well, and having your own choice for the later.
I love the word choice. I love that in life we make choices that have a long term effect on our future. You talk about choices, and I really believe that this conversation is about not just sacrifice, but it's about being able to give yourself choices later in life and to not have to check grocery prices and not have to cut back on the things that make life pleasant and a luxury. And you're referencing the importance of the 30 to 55 age bracket. And I guess I want to really discuss that because me and my friends, we're all in that age bracket. And I think a lot of people don't realize how critical this age bracket is for retirement planning. So, can you tell us why that window is so important and talk about why it's so critical for young people to be paying attention now? Like, why is this window important?
Nowadays, you're thinking about 30 years old is too young. Myself is fully in that bracket as well, but I was actually planning for my own retirement, kind of started from 30, thinking about contributing a bit more into the super. So the reason why I specifically choose this age bracket, thinking it'll be a more suitable time to actually think and plan, is because this age bracket makes the biggest financial decision. When you're age 30, you tend to have partners, try to get married, potentially later on have kids. These are all big transitions in life where it leads you to potentially needing to buy something, buy a home to live in, have some investment funding for kids, and then later on it grows into the 40s and 50s. You're having a bigger investment planning that you also need to make as well. So it is the biggest financial decision period for that sort of time frame. And when you're doing upgrading and taking larger loans, growing families, and also this is probably where people making the most of the working income. So we call it a peak income earning period as well. So this window will give you the most powerful and advantage, in planning time for you to grow, compound sort of investment and interest, and also be able to have a investment portfolio, design what you can do for your retirement or planning and having a passive income structure set up during this period so that after age 55 you'd be more relaxed without any burden.
I love that you mentioned compound interest and like compound investing. Tell us more about that.
So if you do, giving a small example, if you have started putting a taxable or concessional contribution into your superannuation at 30 years old, right? So you can do $200 a month. That's every year. That's already 2,400. And imagine you do this for 10 years in the 40s, it's already 24,000. But on average, the superannuation actually has been making about anywhere between 4 to 5% on average minimum in the last 20 years, in the last 2 decades. So Then if you're including those kind of interest on top, by the time of age 40, you would probably already have about 35,000 extra than your normal employer contribution for your superannuation. So this is what we're looking at compound, right? So you don't feel the pain when you actually just crediting $200 and it's pre-tax. That means it saves your 30-40%, whatever your tax bracket is. And when it goes to super, it's only 15% tax. So you don't feel the pain, but then at the end of the day, you're going to receive extra 30, 40, or maybe 100,000 by the time of 50. And then by the time of age 60, that could be a couple of 100,000 more, not including you be doing other investments within your superannuation. So that's just a very simple example we can look at in super, because that's everyone's related to that. Not even that if you do other investments, if you have a share portfolio, if you don't want to manage shares, you're just looking at Vanguard, some of the ETFs with a very steady return. So this all adds up.
Yeah, absolutely. And I'm definitely one of those people that I think putting a little bit into Vanguard every month or an ETF that is growing steadily, where the risk is much lower, is better than my money sitting in like a gold saver account or something. And yeah, I think that's my philosophy. But obviously, the share market has been rocky lately and people's portfolios have gone down. So, do you think that super is something that everyone needs to be thinking about? And what about business owners that don't necessarily think about paying themselves a super? Is that something that's really important for them to consider?
Definitely. So myself had a financial planning background as well. We always talk about where you do investment, you need to consider diversifying your investments. So it's not about just considering super. You will try to diversify when you do investment and putting your money in different area. You mentioned about your gold saver account. That gives you a guaranteed, a steady interest. You can put partial of your money in the saving account. You can put some in the super. You can do buy some shares. It goes up and down, but we're looking at long term, because signing for retirement is not just a 1 year, 2 year thing, if not a couple of months. It's about 10, 20, 30 years planning. So we have to look at long term for investment. What's the average return in the last decades as well? So for self-employed, this is where a good accountant can kick in, where our specialist team can also assist, because we do provide that strategy session as well. So a good accountant is very important, because they're not only supposed to just lodge your tax return for you. A good accountant will help you with tax planning, right? So it helps you to direct you where your cash flow is supposed to be going. You're making money on the business. Okay, here's your tax bill. That's not how it's going to work. We need to sort of direct the money in different sectors to be more tax effective. We can save tax by contributing money into super. You probably don't see a benefit straight away, but it is less tax, 15%, with concessional contribution. Then later on, when it comes to retirement, you will feel a huge difference. So this is where self-employed people actually need to consider talking to a good accountant or their own accountant to have a session about, planning for some super contribution as well, if they haven't already been doing it.
I definitely think that you're right. I think those are the conversations that need to be had soon and early, because a lot of people don't realize the kind of tax benefits as well of, I'm guessing, paying towards super. I guess probably some people are asking themselves, well, I know I need to pay myself a super, but how much?
When we're talking about concessional contribution, at the moment is 30,000, you get the concessional contribution. So just a quick message, I'm not here to give financial advice. So or all of them are just general advice. We're just giving some general information. Concessional super contribution is about 30,000 per person. So obviously for if you're self-employed, you do have options to do 10, 20, or up to 30. And there are bring forward rules, there are backwards rules. You can make up your previous contributions as well. So on the MyGov, on your superannuation, or with your own accountant, you can actually check how much you missed on the previous year's contribution. You can actually top it up as well as part of the concessional contribution. So there are a lot of benefit and you can utilize as well. So once you've got a good amount of super built up, there are a lot more investment that you can do within the superannuation as well.
Yeah, that's a really, really good point. Going back to financial planning and planning early, what tends to happen if people delay thinking about their retirement, maybe until their late 40s or even their 50s? And also, what shifts if they do start planning earlier?
So I think what I would call it is, if they realize, we often get inquiries of loans and properties when people are 40, late 40s, or maybe after 55, they're always in a panic phase. So people will feel more pressured if they're talking to their friends and someone's already having like 10 million or 2 million even net asset and they were just having one property and not even paid off. So they actually will go into their panic phase. They missed a lot of opportunities. They need to catch up. So if the clock is ticking, they feel forced that they have to, then they feel like need to make bigger contributions. I'll need to try to squeeze in more investment much as we can. We buy more properties, we buy more shares. When the decisions are made too rushed, mistakes can happen very quickly. And because you're planning too late, you're already at a later stage, it's actually going to be hard for you to make corrections. If you make one mistake, that could be your entire savings gone. It is harder. And we do see people try to rush and buying wrong place, wrong property, buying wrong, shares or investment product, or even get scammed. There's a lot of scammer. They are targeting people who actually in the rush to need money to build up their assets. So this is where you have making a lot of mistakes. So we obviously that's why I'm here to try to encourage people to plan for and thinking a bit earlier as well, plan for money a bit earlier.
Yeah, it sounds when people plan earlier, it has a long-term impact. Even if you're not earning at your peak yet, it's still a good idea to start thinking about it really soon.
We often find even higher income earners tend to probably spend more anyway. So no matter what level of income you're in, it's always good to plan early.
Yeah, that's a really, really good point. How do you help your clients understand the difference between earning a high income and building assets that support long-term freedom?
When I was working PAYG, I think my income is really, really good. And I always like say I'm a high income earner. But as I mentioned before, like high income tends to be not necessarily going to be long term. And whenever you make more money, especially when you're younger, like, 20, 30, you tend to spend more. And your lifestyle changes because being a management level, you'll have to sort of hang out with different higher level people. Then you tend to go better places and spending more, save less. And if you don't think about building assets or investment or properties and well structuring your superannuation, your portfolio, the money does not translate into a long-term options. So it's not the high income is not equivalent to long-term options. That's what we need to promote here. So that's why we need different specialists, right? You need accountants, you need legal, you need solicitor, you need your lending specialist, your property specialist to help yourself, anyone to see the difference by having, cash flow versus your actual net worth. You earn 200,000 a year, but you can spend it all. But then you can spend 100,000 and putting 100,000 away into your other investment, build up your different portfolios and planning for the future spending and having the flexibility of take control of your own life, your own retirement.
I guess to continue with what you're saying, I think a lot of the time people can make bad decisions based on, for example, investments, emotional property decisions, or listening to outside people and the noise. And that can obviously have a huge effect on the wealth that they are building. And you were talking about poor structure, and that can lead to higher tax as well because of missed opportunities. What difference does having the right lending structure make to someone's long-term financial picture when it comes to, loans and things like that?
So we can use pretty good examples now. In the last couple of months, there's a lot of changes for banks. The one bank standing out, they had a scam scheme going on with all the fraudulent activities happens and it impact on 60 odd brokers, 60 odd accountants, and then there is hundreds or thousands of brokers being impacted because of the fraudulent activities that happened into that one scheme. So this can have a huge impact on their clients because clients might get in trouble with banks. So that's one of the things. It's on the news, right? NAB, you can probably search. So that's where everyone can be impacted. They might get blacklisted. They might not be able to get loans anymore. And where the other one is just the usual structure where people go online and hear everyone talking about, buying the trust and you can get unlimited lending. You buy trust and company, the banks can exclude the loan. You can just, borrow unlimited as long as you just set up a new trust every time. And think then social media, Facebook, group chat, everyone talking about it, barbecue. You go to barbecue, they start talking about that. And then people just like, oh, I'll follow. I get a limited lending so I can buy millions, bajillions of investment properties. And what happened is 3 months ago, Macquarie stopped lending to trust one for all. Then all the majors start to follow, taking different steps of either tightening up the trust lending, increase the rates, or making it only available for self-employed. So this is where everyone needs to make sure whatever you're planning to do, you talk to a specialist, make sure whatever you're planning to do actually is suitable for yourself instead of just listening to any outside voice and having it to not, being suitable for yourself. We always need to understand a client's long-term goal. What you're planning to do. If you want to buy more property, we need to make sure, okay, we work out based on the best borrowing capacity, cash flow, and maybe do interest only so that you maximize your cash flow to buy another property in the long term. If you just want to pay off your home, then do you have an offset account? Do you have redraw? Do you put all your savings into it? So we always make sure that there is right structure and there's right product that links to this loan as well, so that people can either save money or build a portfolio.
Yeah, that's right. And talking about the barbecue conversations, there's also a lot of people at the moment talking about the SMSF. And a lot of people are now, I guess, investigating that and investing in that too. So I'd love to know, what's an SMSF for the layperson? How's that different to superannuation, or is it just superannuation but self-managed?
Yeah. So SMSF is basically a short version. It's called self-managed super fund. So based on the words, it's obviously just actually yourself managing your own super. So it is for superannuation and it is managed by yourself. So you have the full control of the superannuation. So to understand what is a super fund, is basically more to structure. So you basically set up your superannuation, you go through accountant, then you transfer your usual industrial super retail superannuation fund into your self-managed super fund. It's like a normal bank transaction account technically. So it's called cash management account for most lenders, for most banks. It like a transactional account. You can actually see it from internet banking. How exciting. The thing is you do have regulations to follow as a normal super. You can't just draw the money out in and out like a transactional account, but you'll be able to see it. So you get more happy with the advance. You can now have up to 6 members to join one self-managed super fund together. Normally it's just families, more promoting to families. You can have friends as well. But everyone will be recommended to talk to an accountant, a lending specialist to understand whether that's actually suitable for you, because there are minimum fund required. There are recommended. It's not saying minimum. We have minimum recommended balance into the super. And you do need to understand, if you don't want to manage the investments and everything yourself, it might not be suitable for you, right? So people can talk about it, but you do need to assess your own situation, understand whether you be capable to manage it yourself and follow its compliance. And or on the other hand, if you don't want to manage it and it might not be suitable because you need to monitor the account, you do need to arrange and talk to your accountant for tax return every year. So a lot of people buying properties in super is just because it's the simplest assets they can acquire. Thinking about, buying shares, buying other things, it will be too complicated. They need to do a bit more research. So most people choose to buy properties in the superannuation. Again, we need to understand, talk about diversifying. So our financial planners usually will help on that. Help you diversify, understand what things that they can help you to be able to expand your portfolio, not just on properties only.
I have heard that rather than focusing on returns, sometimes it's actually more just about timing, and structure is often more impactful than returns. So I know we're going back a little bit into investing here, and of course, self-managed super funds the same. But would you say that's the case, that rather than focusing on return, where you're going to get the most return, whether it's an ETF or SMSF or property, rather than focusing on that, is it more just about taking action and timing and getting the right structure?
Yeah. So that's where we're going to go back to the topic. It's about start early, right? If you're starting early, it gives you money to grow the return. So even the very modest returns, we talk about compounding before, you can compound to a larger interest based on a small return in longer period of time. So we can't always look at short-term returns. Like for example, property market, if you're looking at purely short-term return, you could jump into the property market during COVID, where a lot of people actually were scared, during COVID is our property is going to probably go down. But look what happened. After COVID, 3 years in a row or 2 years in a row at least, the average property increases is about 20% for each states for at least 2 years in a row. So, and then most recent year, it obviously becoming single digit increase. So we can't really look at short term, but if we look at long term for the last 10 years, did the properties go up by 100% its value? All of them are. And for 30 years record, it is always being pretty much, 100% value increase. So return is about long term. Because it is the long term, it is important for timing and structure. So if you get it in the early you getting, the better return you get in the long term. The right structure you jump into and getting a defective plan, having your right, portfolio mix for your investment, having the right tax strategy, having the right debt management. That's where the right structure will also lead you to a more effective cash flow management as well. So combined with the timing and the structure, that's where you get the long-term return.
Wow. I love this conversation. Like, you are making me so excited about like jumping into a conversation with my accountant right now and looking into these
Yep.
things, because I feel like, yeah, you've also made, for a lot of people, it's such a dry topic. Like tax time, investments, all of that is so dry. Whereas making your first million and becoming like an influencer and all of that is so much more exciting. And I've heard on social media influencers say things like, what's the point in investing and thinking about return and all of that when you haven't even made your first million? You're only going to make like 20% or 10% of like a smidgen. And I've heard such weird advice all over the internet. But today, this conversation is actually making me excited about starting early, talking to my accountant or my advisor and thinking about these things. And I guess I want to hear, for someone that's listening today, what is one thing, just one simple thing that they can start thinking about now across lending, accounting, property, legal, structure? Like, what's that first thing that people should be doing?
The first thing people should be doing is considering coming to our seminar that's gonna happen next year, March. That's the
Great.
very that is the very one thing that they need to think about. Instead of thinking about across, every single aspects, I just think they be isolated. The reason why we're providing a one-stop shop in consulting and arranging the seminar that actually coming here to promote is provide one stop for everything. It's not about one thing, it's everything. The one thing is everything. But if you really want to break it down to, what things that you can think about, if you don't want to talk about everything and you don't want to get excited about every single aspect, and especially everyone's going to probably charge you money sometimes, is that across lending, you can just ask yourself a simple question. When was the last time you spoke to your lender or broker? Are you on the most interest rate, most suitable product? Do you, have your rate reviewed in the last year or so? 'Cause normally we recommend clients to have at least once a year review for their mortgages. So have you set up the best structure to have the best repayment structure, to have the best product structure? Are you maximizing the that you use on the property as well, potentially, buying more? So just confirming about lending structure and interest rate and products. And with accounting, it's obviously tax planning. When was the last time you see your accountant for a tax planning? Whether you're PAYG, whether you're self-employed, there's always things that you add on. You might be buying shares, you might be, buying properties. There's always going to be tax planning involved, unless you just don't do anything, right? Then obviously we won't have this topic. But by having this early retirement planning, you wanted to start investing, you wanted to start thinking about super. So have a tax planning session, plan out your super contribution, plan out your most effective way of structure your business, planning out, where you can save potentially a little bit of tax as well in the near future. For the property, we always say you can have a look at your portfolios. If you currently already have a few properties, you can still review what is the market, what is the market looks like in the location, how much is the value. Our real estate agent will also give you a little bit of planning to say, okay, here is what you can do to increase this property value, whether it's a build up a granny flat to increase the rental, whether it's touching or doing a renovation, cosmetics renovation to increase the rental income for this property or increase the value of this property. And different location, people has different requirements when they're buying the property as well. So there's things that you need to talk to specialists about to actually do something on your current portfolio to review and maximize the value available on a current portfolio. We can also review the management fees. Are you having the best plan? Are you using the right agency? Are you paying the right fees? For the legal perspective, I always recommend whether you are 30 years old, believe or not, I have a will in place anyway. My parents always say you're superstitious. That even for legal, it's always good to have the right structure planning for assets, where how you're holding your asset, having an estate plan as well, because you wanted to protect your assets. You also want to protect your family as well for the near future. So I'm not saying, people will pass away or anything, but it's always good to have a peace of mind. If you have assets, you have family, you always need to plan to protect them and having the insurance in plan as well. So these are all the important things. So we do give out is for anyone who join our seminar, they will have an opportunity to have a free session with our specialist team.
Oh, that is fantastic. Thank you so much, Jenny. And I just want to say a big thank you for covering this topic for us. I feel like this episode is, there's just so much gold, literally. And I am really excited about this seminar. I think that for people that are wanting to kickstart or start again and like just do things differently, I think your seminar sounds absolutely wonderful. Thank you so much for that free offer as well of that one-on-one session. And to all the listeners, please make sure that you jump on this and you register. I'll be putting a link to the event in the show notes. So all you have to do is click on the description, just click below, see more, and you'll be able to find the link to book yourself in to this seminar. Jenny, is it a online or a in-person seminar, and whereabouts is it?
It'll be in person on the 7th of March 2026. And it will be in Amora Hotel in Jamison, on the Jamison Street in the city, Sydney CBD. So everyone, please click on the registration, and I'm looking forward to see all of you. I think there'll be a lot of content and gold in there for sure.
Yeah, awesome. And for those that are interstate, will there be some kind of online version of that, or will you be doing this in other cities eventually as well?
Yes. So we will be arranging probably 2 or 3 times in the following year. And in the future, we will be doing interstate because we do have our financial planner actually located in Melbourne themselves, and we have real estate agent located in WA. So interstate is definitely the plan as well, but also the videos will be available in social media after the event. So if you can't attend, don't worry, send it to Mari. We are happy to share the full videos in the long term.
Wonderful. Thank you so much, Jenny. Thank you for your time. And to the listeners, thank you so much for tuning in to the Inspired to Thrive and Shine podcast. We are really excited for the year to come. And then we're so grateful to be opening 2026 on a really high and abundant note. And once again, thank you to all our loyal listeners. If you gain value from this show, please make sure to leave us a 5-star review on Apple or Spotify. And if you can, it would be the absolute cherry on top if you shared this episode with your friends and your family, because I'm sure it will make such a huge impact on somebody's lives. So once again, Jenny, thank you so much for being our guest on this episode today.
Thank you so much, Phoebe, for having me here.
So thanks for tuning in, and I look forward to seeing you inspired to thrive.